Very good morning to our MIIM members and friends in Germany, and a good afternoon to our participants joining from India. Thank you for joining us today for the webinar Decoding India's 2026-2027 Union Budget Key Highlights for German Mittelstand Companies, organized under the Make in India Mittelstand program in association with our MIIM partner Chetan and Company and RÖDL. I am Mona Desai-Thansche, your MIIM coordinator in Germany, and I will have the pleasure of taking you through today's session. But before we continue, some technical aspects of our program. In the upright corner of your screen, you will find the control panel. Here you can adjust the audio settings and choose between your headset and the computer audio. A bit further down the dashboard, you will find the question panel. Here we request you to post your questions and we will definitely take them up in the last leg of this webinar. For those who are joining us for the first time, allow me to very briefly introduce the Make in India Mittelstand program. It is an initiative of the Department for Promotion of Industry and Internal Trade and the Embassy of India in Berlin. MIIM provides a platform that integrates a wide range of support services for German Mittelstand companies and family-owned enterprises. In today's webinar, our expert speakers will provide on the recently announced and much anticipated Union Budget of India. We shall commence today's webinar with our guest speaker from the Indo-German Chamber of Commerce, who is also an MIIM partner. She is a very familiar and well-known face in the Indo-German space, Ms. Anna Krieckhaus, Director and Head of the Düsseldorf office in Germany. She is currently heading the German operations with over 20 years of experience managing both strategic and operational functionings. Throughout her career, she has specialized in guiding entry-level and advising various German companies when it comes to joint ventures, product acquisition, inquiry engagement, personnel management to compliance and steering various high-profile delegations to and from India and Germany. Ladies and gentlemen, please join me in welcoming Ms. Anna Krieckhaus.
Thank you so much, Monas. And thank you, all the attendees, for being here today. And it's good for me to see how many people are joining in to learn a little bit more about the budget. I'm not sure, how you're feeling, but every year, beginning of February, I'm really excited. I'm sitting there, in front of my computer, just waiting till the finance minister is actually announcing the budget and the highlights of the budget. And I'm always very curious what's in for German companies. And I'm very happy that we're having so many talented experts here today to give us a little deep dive on what's going on in the budget, what's coming up actually in the next months, what is in there for German companies. And as I said, I really love to listen to the finance minister. Of course I do, when she's just telling a little bit about the budget, but it is way more fun to listen to the analysis of the budget actually, and to hear what is there and, learn a little bit about the nitty-gritties of the budget maybe, but also about the chances and the possibilities that they are there for German mid-sized companies. So I'm so pleased, Monas, and the MIIM team that you invited me to join today and just listen to this. And I have my favorite cup of coffee with me, of course. I have my pen, I'm ready, and I'm really looking forward to hear from the experts what is in there, hear just something about new investing strategies and what is there also when it comes to different sectors, because I already heard that there's going to be something for different sectors. So I'm ready, ladies and gentlemen. I hope you're ready too. So really looking forward, Monas, for the next minutes and hours to just listen and learn more about the budget.
Thank you. Thank you so much, Anna, for joining us today. And additionally, thank you for partnering us in today's webinar. And we are grateful to you and we hope to continue to benefit from your presence going forward. And without any delay, now moving on to our first expert speaker, if I may say, Mr. Anand Khetan, Partner, Director, CFO, Head of Tax at RÖDL. Anand is a partner in RÖDL with deep expertise in goods and service tax, customs, and foreign trade policies. He regularly advises German and multinational clients on complex matters on customs, GST, and trade policy matters. His unique blend of handling litigation matters and investigations by tax authorities equips him to provide practical, business-focused insights. But before we deep into the nitty-gritties of the budget, we need to understand the economic health of a country, which is very critical, and we are fortunate enough to have a pioneer here with us. Ladies and gentlemen, may I present to you my esteemed colleague, Mr. Anand Khetan. Anand, the mic is all yours. Digital mic. Anand, you're on mute. You need to unmute yourself.
I'm sorry. Am I audible now?
Yes. Yes.
Yes.
Yes, Anand.
Thank you so much, Monas, for your kind words. This was really a lot, lot of introduction, but thank you so much for the introduction. And hello, everyone. From my side, on behalf of the MIIM team and all of us here, I welcome all the participants to this webinar, where we try to analyze the Union Budget 2026 presented by our Honorable Finance Minister Nirmala Sitharaman, and try to explain how it impacts especially German Mittelstand businesses in India. That's the objective. See, the budget was announced amongst the backdrop of extremely positive news. Of course, we heard about the finalization of negotiations of the India-EU Free Trade Agreement, which was a big announcement and a big positive news. We also heard about tariff resolutions between India and the US. Then we also had record signing of MOUs promising investments into India at the World Economic Forum at Davos. There was a lot of positivity around, but of course we all know that there are uncertain geopolitical conditions which still cast a shadow on the world economy, and the results could be seen, for example, in the fluctuating metal prices in the recent days in India. So given such an environment, I feel that the budget was extremely positive, and in my view, very growth oriented blueprint, which focused on long-term structural reforms and of course fiscal discipline. The budget balances, I think, ambitious infrastructure goals with a clear path towards macroeconomic stability. Let me take you through some key points in the Union Budget. If you can change the slide, Manas. Next slide. Yeah, next. Yeah. So as you can see, the real GDP has been pegged at 7%. It has been at this level for the last few years, and this is still, India qualifies as the fastest growing economy in the world, a major economy in the world. We still have the record foreign direct investment inflows into India coming in directly, mostly as share capital. We are the 7th largest exporter of services. Of course, we saw that in the budget, the government also is trying to give a big boost to the IT sector, which is sort of the backbone of the service economy in India. On a manufacturing side, few years ago, India was a net importer of electronics, and now we are a net exporter, third largest exporter, in FY 25-26. But the major element has been the capital expenditure. Big allocation towards capex in the budget really shows that the government has a really long-term vision in terms of making India a developed economy. In spite of this, the fiscal deficit was kept at 4.3% of the GDP. As you know, last year it was 4.4%. So the fiscal prudence path is not lost. The government is really trying to balance, public investment and fiscal prudence, together, which shows, very thought through strategy. Next slide. These are some key points, of course, which were announced in the Union Budget. Our colleagues will, of course, dig deep into these and give you a very quick perspective. But from an overall point of view, you can see there was something for everyone. There was, of course, focus on MSMEs, which has always been there for this government. There was an announcement relating to legacy industrial sectors to rejuvenate them. Of course, manufacturing has always been in the focus, and the government keeps on allocating more and more capital towards sustaining and growing the manufacturing in India. There were announcements on the SME growth fund, And on the sector-specific things, you can see that there is a clear allocation and focus on biopharma, semiconductors, electronic components, rare earth corridors, which has always been in the news in the recent past, textiles. And you can see that these are the same sectors which are also being discussed quite heavily in the India-EU Free Trade Agreement. So in all, you can see that the budget tries to address all specific issues which certain sectors face, but at the same time it is trying to ease out doing business in India, which has always been at the focus of this government, and also trying to allocate as much amount to capex so that we are really ready for the future. Before I give the mic to my colleagues to really explain you in detail what was there in the union budget, I would like to spend a couple of minutes on the India-EU Free Trade Agreement, which is the big announcement, which will, I am very sure, change the landscape of India-EU trade. We know that the negotiations are done, but just for information that the process of implementation will take some more time. My colleague will take you through the process, but we expect could be between 6 months to a year, maybe more. Really depends on how fast it's taken up at the government level in the both regions. But on a holistic basis, for Indian exporters, we know that almost 99.5% of the trade with EU will be opened up, which is like a big market. And at the same time, for EU exports to India, 97.5% of the trade, which covers about 92% of the tariff lines, will be opened up. This is unprecedented for India, to do something like this. But for businesses as such, you have to be very careful about how do you really take these benefits, because these concessional rates of customs duty really depend upon rules of origin. For example, if the goods are not manufactured within the EU region, then the concessional rates may not apply. So there is some thought process which needs to go through the supply chain for the European companies in India, and some preparation has to be done on the compliance side to be able to be ready to take the benefits under the FTA. You also have to note that the FTA will also address other aspects, trade-related aspects like the non-tariff barriers on both sides, trade and services, mobility of professionals, especially issues relating to social security, IP protection, which has been a big topic of debate, and also on the investment protection. So I think it is not purely a agreement which deals with movement of goods. It deals with movement of services, movement of professionals, and movement of money. So it is a complete holistic agreement which is going to come out. And I think the business community is eagerly waiting to see this become a reality. With this, I think I give it back to Monaz. This was my short take on the budget. Thank you so much for a patient listening.
Thank you very much, Anand. It was short, but it was significant. Thank you for giving us this comprehensive as well as a summary of the economic well-being of India, and also what the new budget and the FTA means for companies in Europe and India. And I know you wanted to cover much more, but given the time constraint, you have given us a compact picture, which is why you are perfectly positioned to discuss this. So thank you very much, Anand. Moving on, our next speaker, ladies and gentlemen, is Ms. Devika Gandhi. She is Manager Indirect Taxes at RÖDL India. She has been working for RÖDL India Private Limited since March 2017 and has 8 years of experience in providing consulting, litigation, and compliance services to MNCs in indirect tax matters. Her area of expertise include advising on complicated cross-border transactions and tax structuring options for German Mittelstand firms operating out of India. Devika, thank you for joining us today, and this virtual stage is all yours.
Thanks a lot, Monaz. Thank you for the introduction. So I'll be speaking about indirect tax related proposals in the budget. So moving on to the next slide. So when it comes to the amendments that were proposed in the budget, and we could clearly see a theme which was revolving around the changes. So if we come to GST related changes, the theme was resolving legacy issues. So right from the inception of the GST Act, there were certain issues which were troubling businesses And I mean, those were long pending grievances from the business side, and these have been finally addressed. These were first addressed in the council meeting, and now such changes have been now proposed in the budget. So I'll begin with the first change. So the first change is related to post-sale discounts. So earlier on, in case if there was any post-sale discount, that had to be linked with a pre-supply agreement. There was a condition that the post-sale discount can only be reduced from the GST sale supply if there is an agreement in place, pre-existing. Now this condition has been done away with. This was particularly troubling the FMCG, pharma, retail sector, where such post-sale discounts are very common. I mean, it could be based on, it could be incentives based on the sales achieved. So these kind of discounts were really common, and now the issue has been resolved. However, what actually remains is that there has been a condition which has been imposed along with this. So if you have to reduce the value of the credit notes, the recipient has to reverse the input tax credit which they have availed. So again, there's a great increased responsibility on the supplier to actually ensure that this kind of ITC reversal has been done. This can be achieved via the IMS portal. I mean, using the GST portal, this can be achieved, but of course, there's an increased responsibility. This will improve flexibility, pricing, and it will cause fewer valuation related disputes. So this was the first topic. The second change that was introduced in the GST law was the provisional refunds which are available for general export related applications have now been extended to inverted duty structure related refunds as well. So what this means is better cash flow, because provisional refunds under the GST law are usually sanctioned at 90% of the refund that you apply. So this benefit was existing for export related suppliers, but now this has been extended to inverted duty structure related businesses. What earlier used to happen was, because this entire process used to take a lot of time, because there was verification at the end of the office, so there was a lot of to and fro submission of additional documents, there was a little delay in issue of the refunds, which caused liquidity issues. So this is a sort of a relief for the inverted duty structure businesses, that they'll be able to get 90% of the refund on a provisional basis. Second change that was introduced in refund related law was that earlier on there was a threshold limit of ₹1,000 for claiming export related refunds. Now that has been removed. This is particularly to encourage small exporters which are exporting via courier or postal modes. The third change, third significant change that was brought in was, now the government has notified a stopgap arrangement till the appellate authority in advance ruling is comes into picture. So what is happening currently is there are multiple advance ruling authorities at state level in India, and there are conflicting rulings on similar issues. So due to this conflict of issues, there was no central authorities which could resolve this issue at the moment, because the National Appellate Authority has not been formed yet. So the government has now delegated the powers to any existing appellate authority. So this is a temporary arrangement, but certainly there will be relief for such issues. The big one is actually where a lot of attention should be put into is the intermediary service related change. So now these provisions have been omitted from the Act. So earlier on, in case of intermediary services which are provided from India, the place of supply used to be in India. I mean, it was defined to be in India. Now, because of this issue, there was a lot of litigation. There is around 30 billion INR which is stuck in litigation due to this matter. So now it's a big relief for all the people who are involved in such kind of services. It is especially relevant for German subsidiaries. Why? I'll explain it in the next slide. So, Munaz, we can move to the next slide. So I'll try to explain the timeline of this particular amendment. So earlier, when the GST law was introduced, the intermediary services what do we mean by intermediary services? So an intermediary service provider is a service provider who's facilitating provision of goods or services, and who's just a mere facilitator and is not acting on a principal to principal basis. So basically, it could be a commission agent in a layman terminology. So what was happening was, if a service provider was providing such kind of services to a recipient outside India, even though the money was received in foreign currency, such kind of services were made taxable in India, and they were not given the benefit of exports because the place of supply was defined to be in India. So due to this, I mean, there was a lot of negativity or a lot of negative impact on, especially for the BPOs, GCCs, marketing and sales support companies which are operating from India. Now finally there's clarity, and now the place of supply is defined to be outside India. So such services will most likely qualify as exports. The benefit of zero rating will be available. Now we have to see that if in case there's accumulation of input tax credit because they will amount to exports, then such recipients, such service providers will have to claim GST refunds, but that will see after that. The businesses have to check after 2 years or 3 years of time. Another big impact here is, earlier on we used to advise that, or it was advised that agency model has to be really reconsidered, or has to be really looked into, because there was a GST implication. Because if a subsidiary was providing marketing and sales support or a commission related service, that was taxable in India, and this tax was a cost to the holding company. So now actually this is a big relief for such companies, and now agency models can again have become lucrative for the companies. What businesses can do now is just see whether their services qualify as intermediary services, actually check whether agency model makes more sense for their business now, and review their existing agreements, intercompany agreements. We can move to the next slide. So this was a GST related. Now coming on to the customs related proposals, the theme here was trade facilitation. Even during the budget, we could hear a lot of measures that the finance minister had, I mean, actually during her speech pronounced about facilitating trade, or actually moving towards trust-based governance. There are 4 or 5 changes, important ones, that we are going to discuss. The first one is in section 67 of the of warehouse related amendment, wherein in case if there was an inter warehouse movement of goods earlier on, officer permission was required, or approval from officer was required to cause such movement. Now this requirement has been done away with, and now such prior approval will not be required. This will again lead to faster movement, and I mean, the roadblocks or hindrances will go away. So this is the first one. The second one is that earlier on in the customs law, the penalty related, there were the penalty which was applicable in case of misrepresentation, or in case of I mean, errors which did not amount to fraud, were termed as penalty. Now the government is insisting it to, color it as a charge. Because they don't want it to be seen in a negative light. They want to encourage voluntary compliance and trust amongst taxpayers. So penalty has now been rebranded as a charge. And similar kind of changes we could see in the direct tax related speech part of the finance minister as well. Another big change that the finance minister announced in her budget speech was there was a proposal to permit SEZ manufacturing units to make DTA sales at concessional duty rates. I mean, this is a one-time arrangement that the government is allowing to you really utilize underutilized capacities of SEZs to encourage the utilization. They'll come up with a one-time scheme. The details have not come out yet, but will be prescribed in due time. Another important change is that the tenure for advance ruling under customs has now been, the validity tenure has been extended from 3 years to 5 years. This means that there's going to be greater stability taxpayers can actually expect consistency, stability for a longer duration of time. This can further be extended to 5 more years upon request by the taxpayer. There was some rationalization on the baggage rules which are relevant for international travelers. I mean, this was long due since last 10 years, and now the government has finally made the changes. There are some increased limits and reliefs, which the details of which are yet to come. Monas, we can move to the next slide. Yeah, so the most relevant change actually that was brought in for Indian subsidiaries who are heavily importing from outside India is that there's a duty deferral duty deferral scheme that has been introduced. So the AEO scheme used to exist earlier on, and now the timeline has been, the deferment period has been increased from 15 days to 30 days for AEO T2 and T3 category accreditation. So this will allow greater time for businesses, and it will improve liquidity. This is again a shift to trust-based governance from the government side. It will improve ease of doing business. The AEO scheme has surely become more relevant and lucrative. The government wants to push this scheme and wants taxpayers to avail this scheme now. Another similar kind of a scheme with a sunset clause, of course, has been introduced, wherein eligible manufacturer importers can avail this deferment upon application being made to the DIC. But the details are yet to come, but surely it will be in the line of the AEO scheme. We can clearly see that the government is wanting people to get this accreditation. It is also important because this accreditation is seen as a I mean, if a taxpayer avails this accreditation, they are seen as really good in international front as well. So overall, internationally also, it is really recognized. It has multiple benefits, faster clearances, less paperwork, reduced amount of bank guarantee requirements, and quick completion of investigations. So there's a push to this scheme from the government side. So yeah, we can move to the next slide. In the customs tariff, there were some structural changes. The tariff structure has been this has been going on since last 2-3 years, where the government has removed the conditional exemptions and notifications, and the government really wants to truncate it and put everything in the customs tariff itself. So this will certainly, I mean, rationalize the rates. The effective rates remain same, but the notifications and concessional related documentation has been now truncated, and everything is shifted or rehoused to the custom tariff itself. For the businesses, this of course entails a review of their existing tariffs and entries in the ERP system. They really have to see what has changed. There are certain new tariff entries also being introduced given the EU FTA, so that also has to be looked into from the business side. We can move to the next slide. So quickly, the customs tariff related changes. There is a clear theme where we can. There's a clear theme here where we can see that the inputs are taxed at a lower rate, and the finished goods have been taxed at a higher rate, just to promote the domestic manufacturing here in India. I actually want to move a little faster so that I allow other speakers to speak. So here I'm just speaking about the general theme. The theme has been that the inputs have been taxed at a lower rate, and the finished goods have been taxed at a higher rate to promote domestic manufacturing here in India. We can move to the next slide, Monas. About the EU FTA, Anand has actually already spoken about this. The FTA is the negotiations have been concluded, but there's a lot to be done from both sides. So it will take around 6 to 12 months. There are a lot of steps which are involved, and again, finally, it will be implemented in a phased manner. So I think we can skip this for now and we can move to the next topic. So yeah, very quickly, I mean, like Anand also emphasized, though there is still time for the FTA to be implemented, but the readiness has to start now. So how we look at it is we can divide the readiness into three baskets. The businesses have to be compliance ready. They have to strategize their commercial strategy, and you have to look at their regulatory aspects as well. So this will include conducting product-wise tariff impact, actually looking at their market expansion opportunities. Now is the time to form strategic alliances and JVs with EU partners. Now is the time to review your supply chain and to see where you can source from or manufacture at to optimize the maximum benefits at. And the most important part here is to look at the rules of origin and documentation readiness, because these will be very important to actually avail the benefits of the FTA. With that, I would actually give it back to Monas for the next topics to be discussed.
Thank you, Devika. Thank you very much. You've definitely hit the nail on the head. Number one is that this budget has definitely opened new market opportunities in key industrial areas. Only the German companies need to have faith and invest in it. Also, thank you for addressing us and sharing those valuable inputs on the indirect sale aspects. And we've seen that you've highlighted that everything is not very clear in terms of penalties and consequences and what one needs to keep in mind. I hope everyone has made notes that all is not clear and one needs to wait for further clarification and clearness from the government agencies. Now, moving on to our direct tax session of the webinar, we have joining us is Mr. Chetan Kakariya, Partner, Indirect Taxes, Head of Tax and International Tax. He has 7 years at the firm and with over of hands-on experience. Chetan advises a wide range of international clients, particularly German Mittelstand companies, on corporate taxation, international taxation, India entry strategy, direct tax compliance and advisory, direct tax litigation, expat taxation, to name a few. He regularly undertakes and delivers sessions on domestic and international tax. We are very lucky to have him here join us today. Thank you, Chetan, for your time, and we are looking forward to hearing from you.
Sure. Thanks, Monas, for that quick round of introduction. With this, I will directly get into that.
Chetan, you are on mute.
Yes. So, thanks, Monas. I will now get into direct and international tax proposals. If you can go to the next slide, please. So this is the tax rate chart for the corporates who are doing business in India. And there is no change in this rate structure, except for minimum alternate tax that companies need to pay in certain occasions when they don't have sufficient tax liability under the normal provisions of the law. So that rate reduction has been not very significant, but there are certain other changes in those provisions, which we'll cover in one of the subsequent slides. With that, we will move to the next slide, please. So some significant announcements that were there in this year's budget are really noteworthy. And why they are very significant, I would say, is because somewhere the government had made it clear in past that they don't want to really introduce new tax holidays. So they had actually phased out the tax holidays that were already there for many years to various sectors. And really they were moving towards reducing the tax rates but not giving any tax concessions as such. Now there has been some kind of tax concession that has been brought in, and that's why it is very significant. Particularly these are upcoming industries in India, and it has been realized that there needs to be a kind of a boost given to these industries, and so these proposals are significant. They really kind of make it clear the government's vision that they want to support the industry. So one is on data center services, where if a foreign entity is serving its clients through the support of Indian data center, then what income they would be earning out of it, uh, like there could be a dispute that okay, whether some portion of that income needs to be actually said to be earned in India, arising in India, and that's why it should be taxed. So to kind of avoid such controversies and give them a kind of really a boost to concentrate on business rather than tax litigation. So those activities are said to be not resulting any taxable income in India for foreign companies. And there is a very long period of certainty up to 31st March 2047 that till that time this will not be taxed. In case the Indian data centers entity is a related party to the foreign data center, foreign entity which is availing such services, then there is a safe harbor also provided. So Indian entity can charge cost plus 15% markup, and for them there will be a tax certainty beyond that. Similar is the case in case of electronic component or equipment industry, where certain capital goods, equipment, tools are required to be provided. And in such case, if a foreign entity is providing this kind of capital goods to the Indian contract manufacturer, then there could have been an issue that whether foreign company is having a permanent establishment in India because they have this kind of capital equipments in India through which the manufacturing activity is undertaken. And now it is proposed that again for this kind of activity also, foreign entity will not be subject to taxation in India up to 31st March 2031. So again, kind of very long-term stability is provided so far as tax treatment is concerned for the foreign companies that can generate some income through the support of Indian entities. With that, we move to the next slide, please. There is a change in case of buyback of shares related taxation. So really there has been some bit of back and forth, like whether how should it be taxed, because generally the companies declare dividends and they have a different rate of taxation. And in case they resort to buyback of shares, then there is a different rate of taxation. So really the rate disparity between taxation of dividends versus taxation of buyback of shares has been a matter of contention for tax department, that there may be an attempt to avoid taxes by having a buyback of shares instead of dividends. So that they have tried to sort out. And at the same time, they have taken care of smaller shareholders, that they may be still liable to tax at normal capital gains tax rates, but the promoters would be taxable at higher rates. We can move to the next slide. So, as I mentioned, that minimum alternate tax, or we call it as MAT, there is a reduction in that. Again, we know that Indian companies are provided a concessional tax rate regime. They can be taxed at 15% plus such as cess if they are new manufacturing companies, or other companies are eligible for 22% plus such as cess, which is effectively 25% tax rate. So those companies are anyways not subject to MAT. But there were some companies which were continuing under the old regime, although the tax rate was higher, because they had certain minimum alternate tax paid in past, and that credit was carried forward. So they were not able to move to the new regime because such credit was not available to be set off. So now it has been allowed to set off such credit against the tax liability under the new regime. So while they are not now going to be allowed under the old regime, the credit set off. So this is a move to kind of try and push the remaining companies also to the new tax regime, so that they can benefit out of MAT credit set off, and they can in future also benefit by the lower rates under the new tax regime. Another welcome change is certain employee contributions. What contributions are collected from employees for various welfare schemes. For them, there is a higher timeline provided to deposit with the respective authorities, and still the deduction will be allowed. So this is again a good change for the corporates. Let's move to the next slide, please. So there are certain tax return filing related changes. So we may not need to get into all the intricacies. But one of the important changes is that there are certain if there are certain mistakes in filing the tax return, then there is a provision to file updated tax return by paying certain extra tax, and you can get out of the penalty prosecution related hindrances. So that provision has been broadened, and some new categories have been introduced to further give such benefit of filing updated tax returns to the companies who may have missed out declaring certain incomes, etc. With that, we can move to the next slide, please. There are certain, I think, changes in tax deduction related provisions, not so significant. But one of the noteworthy is, again, here again, government has really given an attention to certain requirements of people. And the remittances for, say, education or medical treatments. So there earlier, the tax withholding was at 5%, and that has been reduced to 2%. So this also somewhere gives some relief for the people who may actually find it difficult, the cash flow blocking and all that. Yeah, we can move to the next one. There have been actually a lot of changes on penalty and prosecution provisions. Really, the attention has been provided to a demand that certain provisions should be decriminalized. There are certain rigorous imprisonments provided for certain offences. They should be either moved to the simple imprisonment, or the duration of the imprisonment should be reduced. So a lot of changes actually have been done on that count. In fact, very many cases, the penalties have been moved to the fee structure. So it becomes a bit automated, and there is no need to have a litigation around that. Another change is regarding the immunity from penalty. So earlier, so there are two categories of penalty proceedings. One is there can be a underreporting of income, or there can be a misreporting of income. So in case of underreporting, there was a facility to avail immunity by following certain conditions. Now, even such facility has been extended to the cases where there is a misreporting of income. And why it becomes important is because there is a 200% penalty in case of misreporting of income. So that penalty can reduce significantly if you opt for immunity under that provision. So again, these are the changes to somewhere keeping in mind that there could be certain genuine issues, challenges, certain wrong positions taken under some pretext. And so there are opportunities given to actually correct these things, and even reduce the penalties, move to the fine related provisions rather than having imprisonment in all the cases. So, so a lot of change on that front. Yes. Next slide, please. Individual taxation, again, no rates changes, but one of the significant change is that there will be, like there are certain cases, the upcoming industries again, where a lot of talent from outside India would be required. And so if there are these foreign non-residents who are non-residents in India for the past 5 years, if those people are moving to India for providing certain services, the scheme needs to be notified. But in those cases, their income that is earned outside India would not get taxable in India for 5-year period. So although they become resident, their worldwide income may not become taxable, and to that extent, they would have a certainty on taxation in terms of that global income not getting exposed to Indian taxation. Yes. Next slide, please. One of the another change that is again to facilitate like the cash flow issues at taxpayers is that in case taxpayers suffer some adverse orders. So earlier there was a requirement to pay 20% of demand, and balance demand used to be stayed. Now that threshold has been reduced to 10%. So again, cash flow perspective, it benefits the companies who suffer some kind of adverse tax additions from tax department. So these were some of the important changes. There are, of course, some other detailed changes also, but we'll not get into each and every intricate change. And with that, I'll end the session on direct and international tax, and now back to Monas for transfer pricing.
Thank you, Chetan, for that insightful navigation through the maze of corporate tax, and also thank you for sharing those critical notes on how to stay on the right side of the local laws. something that I'm sure you and I both agree to. Supporting him, ladies and gentlemen, is our next speaker, Ms. Gauri Bivare, Associate Partner, Head of Transfer Pricing. She has been working for RÖDL India Private Limited since January 2020 and has over more than 10 years of experience in providing consulting and litigation services to MNCs in transfer pricing matters. Her expertise range from transfer pricing advisory, transfer pricing litigation, to supporting transfer pricing compliance-related matters. Gauri is also deeply involved in providing advisory services to German companies on business modeling, business restructuring, and intercompany pricing arrangements, along with providing assistance in preparation of transfer pricing audit reports and local files. Gauri, thank you for your time and thank you for joining us today. Thank you.
Thank you, Monas, for the kind introduction. Let's move to transfer pricing section now. Next slide. Thank you. So in this budget, the government has made important changes to the transfer pricing framework by strengthening both safe harbor rules also and APA mechanism. We all know that the transfer pricing landscape has been recognized as one of the most litigated, but there are tools introduced to address this issue, and safe harbor rules were meant to provide the certainty. But over the time, they failed to achieve that promise also. So today, in the recent budget, the government has revamped these rules regarding the safe harbor. To know how these will now benefit to the industry, it's very important to know what challenges were there the businesses faced. The safe harbor rules were introduced to provide taxpayer with an assured margin so that if the company operates within that margin, the tax authorities would accept their transfer pricing without any dispute. But earlier framework carried several limitations. The monetary thresholds were set too low, making mid-size or large-size service providers ineligible to opt for the rules. At the same time, the prescribed margins were often higher than the market realities, and also the sector-wise categorization of IT services created issues in opting out the rules. So software development, ITS, KPO, contract R&D in relation to IT services were treated differently, despite the fact that these services are very much interlinked and integrated. Now this budget has addressed these issues. One of the most impactful change is the consolidation of all these IT-related services, that is software development, ITS, KPO, and contract R&D, into a single unified information technology services category and a uniform safe harbor margin that is of 15.5% to apply on these services. So by creating one category and applying a single safe harbor margin of 15.5%, the government has aligned these rules far more closely with the industry standards. This budget has also made the safe harbor region accessible to many more companies now by increasing the eligibility threshold from 300 crores to 2000 crores. It means that now even mid-sized company, larger IT service provider, then now GCC units who other couldn't benefit because of the low threshold can now opt for the safe harbor rules. Another change is in relation to the procedural part. Earlier, the system required office level examination, application that created delays also, then left room for the discretion. This new budget introduces a fully automated and rule-based approval mechanism, which removes the need of any manual scrutiny by the tax officers now. So this makes the process more faster and I would say the more transparent. So once company opts for the safe harbor, it can continue with the same margin for the next 5 years. So this entire shift, what I feel, improves the ease of doing business by reducing disputes. Next slide. Yes, so the next change is in relation to advanced pricing agreements. Over the years, we know that APAs are also have been considered as one of the India's strongest tool for resolving transfer pricing disputes. By March 2025, the CBDT has already concluded around 800, 8 to 25 APAs. So, despite of this success, the businesses constantly reported challenges. So, especially in the time taken for the conclusion of these agreements. So unilateral APA cases routinely stretched beyond 3 or 3.5 years, resulting in prolonged uncertainty. So recognizing these concerns, this budget has introduced a series of reforms in the APA processes also. The government has now proposed a fast-track mechanism for unilateral APAs, especially for the IT sector. These agreements will aim to be completed within 2 years, with the additional 6 months of extension available if requested by the taxpayer. Further, there is one more important improvement. Earlier, the only company who had signed APA was allowed to file modified return, which gives effect of APA. Associated enterprises affected by these APAs were not allowed to revise their returns, even though their taxable income had changed or has impacted due to this agreement. So now, with effect from 1st of April, this 2026, associated enterprise will also be eligible to file this modified return, giving effect to APA agreement. So just like the main party of or the taxpayer, they have to file this modified return within 3 months from the end of the APA conclusion. AEs can also file the modified return in the same way. So this amendment gives a practical relief to the AEs also now. So overall, these reforms of safe harbor and APS will, of course, reduce litigation and will be a predictable hub for the global service provider in future. Of course, we need to wait for the rules to be released and check whatever is discussed or promised in the budget is actually reflects in the updated rules. Next slide. Yes. So another important change is in relation to the delays or non-filing of Form 3CB, which is a transfer pricing audit report if you don't file within a due date. Earlier, the law provided for a penalty of rupees 1 lakh, and that too was levied at the time of assessment at the discretion of the transfer pricing officer. So whereas now this penalty has been converted into a graded fee structure of 50,000 for the delays up to 1 month, and for all the disputes or delays thereafter, a fine of rupees 1 lakh will be levied. So it's more likely that this is a fine we need to pay for the delayed filing, like we pay the fine at the time of, means if we file return on delayed basis. If we file the return on delayed basis. So now next two changes are clarificatory in nature and are the procedural part. So the first I will just run through because these are just clarificatory in nature relating to the timelines to be followed by the officers. So first is in relation to the time limit that is available to the transfer pricing officer or the assessing officer to complete the assessment. So there was a confusion about whether TP cases handled through DRP route must still follow the overall limit, which is mentioned under section 153. And this issue has become big after the Madras High Court case of Roka bathroom. So it was interpreted that even the DRP route is followed, the time limit given under section 153 will still prevail. To settle down this dispute now, it's clarified that if assessee opts for the DRP route for the purpose of litigation, then so the time limit given under section 153 will stop there, and what are the timelines given under section 144C will apply while completing the final assessment order. So another point is relation to the how to compute the 60 days available for the transfer pricing officer to pass the order. So it's now concluded that the last day has to be included while computing the limitation period, and the same effect has now been incorporated in the IT Act 2025 also, because we are moving to the new tax regime. Another small change is that all the dealings between associated enterprise and its SEZ units in India will be now outside the purview of the transfer pricing regime. So with that, I conclude with the transfer pricing highlights, and I now again hand it over to Monaz to take it further. Thank you, everyone.
Thank you. Thank you very much, Gauri, for sharing these insightful statistics, parameters, and how to incorporate and understand these vital aspects of these revised compliances, if I may so. Now we enter the final part of the webinar, regulatory development. Regulatory development is crucial for any economy. One needs to know the rules of the game. Effective and efficient regulations align better business practices, promote sustainable growth. We have here with us today Mr. Prasenjit Chakravarti, partner at Khaitan Co. Khaitan has also been a long-standing partner of the Make in India Mittelstand program. Prasenjit comes with over 20 years of experience in advisory. He has led complex domestic and cross-border transactions across sectors such as automotive, renewable energy, chemicals, telecom, and technology, acting for both strategic buyers and financial sponsors. Prasenjit is also part of Khaitan's German desk, which offers dedicated cross-border legal support and seamless India-Germany advisory services for firms looking to invest and operate in India. Prasenjit has been recognized by Asian Legal Business as a Super 50 lawyer and by Legal Era as a leading lawyer champion, corporate and M&A section. Prasenjit, thank you for joining us today, and we are all ears to hear you.
Many thanks for the kind introduction, Monaz. Hello, everyone, and thank you for joining today. I realize I have the unenabled task of being the last speaker, which usually means two things. Attention spans are shorter and expectations are higher. I will try to respect both. A lot of important ground has already been covered today, particularly around the macro context and the tax ramifications of the Union Budget 2026. So instead of revisiting that, I want to spend the next few minutes on a narrower but very practical question. From the perspective of German and European business, what does Budget 2026 actually change? And what does it deliberately leave unchanged when it comes to regulation, governance, and deal execution in India? For many German Mittelstand companies, clarity on regulatory process, compliance expectations, and execution risk often matters as much as headline growth or incentives. Budget 2026 is interestingly precisely dealing with that because it does not attempt to reset the system. Instead, it reinforces continuity and focuses on how rules are implemented in practice. My remarks will therefore focus on what Budget 2026 means for corporate India and for deal makers from a regulatory and governance standpoint, in particular how it affects execution, compliance discipline, and transaction certainty rather than tax outcomes, which my colleagues have already covered. The first point on this is, that policy continuity and regulatory predictability. In my view, this is the most important point for anyone running a deal pipeline. Budget 2026 is above all a signal of policy continuity. We have not seen a disrupting rewriting of the corporate law or investment framework. There is no new Companies Act or no sudden change to the basic foreign direct investment architecture and no unexpected shift in how core sectors are regulated. That matters because investment decisions are made on multi-year horizons. When capital is committed for 5 or 10 years, the real risk is not regulation itself, but regulatory volatility. From a deal maker's perspective, the most important takeaway is what the budget did not disturb. It reinforces the message that India is focused on consolidating and implementing reforms rather than constantly resetting the rule book, a critical factor for long-term capital. The second theme is what I would describe as ease of doing business 2.0. We are past slogans. The focus is now on execution, greater digitization, clearer timelines, targeted decriminalization of technical offenses, and a gradual shift from event-based rather than purely annual compliance. You see this in expanded online filing systems, increased emphasis on time-bound approvals, and the steady rationalization of licenses and registrations that sit around doing business in India. This is directly relevant to German Mittelstand companies that consistently cite bureaucratic complexities and uneven approval timelines as the biggest operational concern, particularly at the state level. In deal terms, this translates into faster closings, tighter closing conditions, and materially reduced long stop risk. Today, the key question is no longer just is the approval required, it is can I reasonably predict the process, the timeline, and the documentation. Procedural certainty is what now defines ease of doing business in practice. The third theme is FDI and capital inflows. This is not a budget characterized by headline-grabbing liberalization. There is no sweeping opening of new sectors. What it does provide is continuity. There has been no rollback of the existing FDI framework, including the more cautious screening discipline introduced in recent years, and no last-minute changes that force foreign investors to reprice regulatory risk mid-transaction. For inbound investment, this predictability is often more valuable than the marginal new openings. Investors value rules that remain stable between term sheet signing and closing because that allows regulatory risk to be assessed and priced with confidence. For German and other European investors, this sits alongside a broader political signal that India is a priority destination for manufacturing, research and development, and green investment. The message on foreign direct investment is clear. The framework is intact, the direction of travel is familiar, and transactions can be planned accordingly. The fourth theme is the continued public infrastructure and capital expenditure push. At first glance, this appears to be a macroeconomic story. But for deal makers, this is often where the next wave of transactions originates. When the state builds, the private sector consolidates. Sustained public capex typically leads with some lag to platform acquisitions in infrastructure, linked sectors, bolt-on deals in manufacturing and EPC, and consolidation in renewables and allied services as assets move from development to operation. Many of these sectors, renewables, industrial equipment, logistics, and advanced manufacturing, align closely with areas where German technology and capital are already active in India. For Mittelstand manufacturers, this can translate into more viable partners and locations for a first or even a second plant on the ground in India, with clearer visibility on logistics, power, and supplier ecosystem. Even without any direct investment incentive, today's capex decisions are shaping tomorrow's deal pipeline. The fifth theme, and arguably the most significant from a corporate law perspective, is governance. The regulatory mindset is continuing to move from box ticking to substance. There is a growing expectation that boards can demonstrate governance readiness, effective risk oversight, and robust internal controls, not merely a formal compliance. For investment, this has three clear implications. Firstly, diligence goes deeper. Related party transactions, legacy compliance gaps, unresolved regulatory matters now directly affect valuation and deal structure. Secondly, we are seeing greater use of escrows, indemnity holdbacks, and deferred consideration to allocate governance and compliance risk, particularly in private transactions. Thirdly, boards on both sides of a deal are increasingly expected to articulate how regulatory and governance risks were identified and assessed before approving the transaction. Regulatory risk has become a valuation issue, not merely a legal issue. That is a meaningful shift in deal dynamics. Sixth point on this would be ESG. Now, closely linked to governance is ESG, which is the G of ESG, and it is viewed in practical transaction-oriented terms. Budget 2026 reinforces India's long-term sustainability and green growth objectives without creating a standalone ESG regulatory regime. Energy transition, green infrastructure, and climate-aligned growth runs across policy and spending priorities. From a deal perspective, ESG gaps increasingly translates into pricing discussions. ESG readiness supports smoother exits, particularly in cross-border transactions, where German and European buyers face strong expectations from their own regulators, lenders, and investors. as EU sustainability and supply chain rules tighten, having Indian partners and subsidiaries that can withstand ESG diligence makes life materially easier for Mittelstand boards. ESG has become another layer of commercial diligence alongside financial and legal analysis and is now firmly part of mainstream deal making. With that, I think if I have to give a quick 3 points takeaway, uh, those would be firstly that stability itself is an asset, where strategic transactions were deferred due to concerns around regulatory uncertainty. This is an environment currently in which they can be revisited with greater clarity. Secondly, governance and compliance are now central to transaction value. Clean histories, strong controls, and transparent processes improve pricing structure and certainty of execution, particularly when accessing European and German capital. Lastly, the company's best position to attract investment and execute transactions will be well governed, business built for scrutiny, capable of withstanding regulatory diligence, ESG review, and board level questioning. In 2026, the regulator is not asking companies to do more, it is asking them to do things properly and to be able to explain them. If boards and deal teams align to this reality, the combination of policy continuity, procedural reform, sustained infrastructure investment, deeper India-EU engagement can support a very healthy environment for both domestic and cross-border M&A. Thank you for listening to me.
Thank you. Thank you very much, Prasenjit, for sharing what opportunities and challenges that lie ahead from a regulatory aspect to geo-economic aspects and all that needs to be considered. Now we will turn, ladies and gentlemen, to our Q&A session. We have some great questions in the pipeline for our speakers today. So we will start with Chetan here. Chetan, the first question is for you. For resident Indian in Germany, what tax benefits are there in the current budget?
I think as we discussed, there have been no tax rate changes as such. But tax rates is not the only thing I think that we need to look at in budget. But I think as we discussed, there is a scheme that is proposed to be brought in for foreign, the non-residents particularly. So the non-residents who are going to work in some specified fields in India, they would be getting some tax benefits. So that is one change and it can be resident Indian, it can be a foreign national, but that person needs to be non-resident for past 5 years. So that is one of the changes, but very specific. And then there are certain changes, procedural changes, like if there is some miss out in past years, then updated tax return can be filed. There are some relaxations over there, or there are some other like foreign asset disclosure. So I think to kind of take care of the past baggages, I think some changes have been introduced that should help. Yeah.
Thank you. Thank you so much, Chetan. Moving on, next question to you, Devika. What are the prospective changes for Mittelstand companies in Germany and India under the new FTA? Would you like to briefly comment on that?
Yeah. So the new FTA is rightly actually called the mother of all deals, because it has a lot to offer both for India and for German Mittelstand companies. Actually, it will open up greater market access for German companies in India with near to zero duty rates for a lot of products which has been, proposed. Almost 97% of the tariff is going to be revamped and reduced. So that's a big advantage over there. Rules, of course, will be simplified. There will be faster customs procedures. So all of that with the market access and reduced tariff would definitely has a lot to offer for the German Mittelstand companies.
Thank you. Thank you. Now moving from mother of all deals, I jump to ease of doing business. Prasenjit, this one is for you. From a German Mittelstand company perspective, where would they draw the greatest comfort after seeing this budget? Is this the new era of ease of doing business 2.0?
Yeah, so I think as I broadly discussed, Monas, that if I translate the union budget into broad level decision-making lens, the real comfort lies in execution certainty rather than new big bang policy announcement from corporate standpoint. What budget 2026 effectively signals is that if capital is committed today, let's say the German company, Mittelstand company, the regulatory assumptions made at a signing are likely to remain valid through closing and into integration. That stability matters perhaps far more than incremental incentives. Practical terms, regulatory process are becoming process-driven rather than relationship-driven. For a German Mittelstand company expanding capacity or integrating an acquisition, the risk is no longer whether approvals will come, or, but how predictable the process and timelines are. And that distinction, I think, is critical for investment committees. So I think the budget coupled with the India-EU engagement has added a further layer of comfort, not through immediate legal change, but through directional alignment on governance, sustainability, and supply chain standards. So yeah, I mean, the post-budget comfort is India today allows board to plan investment and transactions with far greater procedural predictability, and that predictability is what unlocks long-term capital.
Thank you. So if I may get it correctly, it is processes and policy has to work hand in hand.
Correct.
Yes, thank you. Moving on, next question is to Gauri. How should Mittelstand companies interpret recent trends towards tax dispute resolution and reduced litigation?
Okay, so the changes to the safe harbor rules and APA program right now in relation to the IT sector will make life much easier for the businesses henceforth, especially for the middle-sized company, because the government has widened the limits and the scope of the rules also, and it will allow more companies to use a fixed or a pre-approved profitability and avoid lengthy scrutiny. And if you are not captive company and if you are having a higher risk profile for the business, so APS can also be considered as a good option for quick and a reliable way to agree on the pricing with the tax authorities in advance. These changes will really help companies to focus on their business and rather than focusing on the litigations and costs related to those. So this
Thank you.
how it will help to the current budget.
Thank you. Another question for the indirect tax team here. What is the impact on the mother of all deals with India, especially with regard to the automotive sector? I know this is not a yes or no answer, but would someone try their best to revert on this? The automotive sector has been affected most by the mother of all deals.
Yeah, I'll try to answer this question. And there are several aspects to the automotive sector which we have to first understand. First fact we know is that when you import CBUs, or completely built unit, as a car in India, the customs duties are pretty high. So they go right up to 100, 110%, and then you have to pay, of course, the import VAT. And this has been a point of contention in the past as well, where people have been saying that these duties are pretty high. And of course, from an Indian point of view, this is to protect the domestic car industry. So if you import CKD kits or raw material, of course, the customs duties go down to 30% and 15% and 10% gradually. Now, the impact of FTA on the automotive sector is expected to be positive, not a big impact, I would say. First, because India would open up the CBU sector, so the completely built sector, only up to a certain quota. So this is how it has been agreed with UK. This is how it will be agreed with EU as well. So only a certain number of cars will be allowed under concessional rates under the FTA, not every car and not unlimited quantities. Now, usually manufacturers would try to then segment high value cars into this FTA, because there's no point getting low value CBUs in India and then try to get a benefit under the FTA. We also have had a statement from Santosh Iyer, who is the managing director of Mercedes-Benz in India, and he has come out with a statement where he has said that this FTA will not have a significant impact on the pricing of cars in India, especially on the CBU side as well, because you have to factor in a lot of other aspects. So in a sense, this will have a big effect on the clearance procedures, maybe more availability of models which are currently not there in India. But on the pricing side, may not be such a big game changer. If you are a local manufacturer already, like Mercedes or Volkswagen or Audi, then the benefits will, be about 10%, which is, reducing from 10 to 0 maybe. So that would be the impact, not more than that.
Thank you, Anand. And I think our audience here also might agree that the Indians do have a large appetite for new models, especially coming from Germany, and moving from, if I may say, barns, auto barns, to the boardroom. Our next question here is to Prasenjit here. How should German board members address issues on ESGs, governance due diligence on Indian parts or subsidiaries? What advice would you give an Indian counterparty to have in place and to be genuinely board ready for an investment or M&A transaction?
See, again, I think post-budget 2026, ESG and governance should be viewed by German boards as transaction readiness issues, not as standalone sustainability exercises. In practice, ESG and governance diligence increasingly determine how deals are structured, not just whether they proceed. So board should focus less on policy documents and more on operational reality, how risks are identified, owned, and explained. So a genuinely, board-ready Indian counterparty is one that can withstand regulatory and board-level scrutiny, not one that simply produces perfect paperwork. So what it means is this will include clear accountability at board and management level, auditable ESG and compliance data generated internally, transparent handling of related party transactions and legacy issues. In deals, these shows up very tangibly. Governance weaknesses again translates into escrows, as I mentioned, indemnity, holdbacks, or deferred consideration, while strong compliance histories improve pricing certainty and speed to closing. Budget 2026 reinforces this direction quietly but clearly. The regulator is less concerned with the form and more with substance and explainability.
Thank you. Thank you for putting those in very comprehensive and clear words here for us. We try to close this, but we still have another question for indirect tax. How to avail the customs duty deferral scheme? Perhaps point-wise, if one of our speakers would like to take it up as a challenge.
Yeah, so for the customs duty deferral scheme, I think it's about the change which is now being introduced in the budget currently. So out, but the application has to be made to DIC, at least that is clear, but we'll have to await for that. But the AEO scheme is already in place, and of course, I mean, the regulations are in place. There's a procedure to it. It goes from tier 1 to tier 2 to tier 3. If the existing scheme can be availed, I mean, if they want to avail the existing scheme, that can be looked at as an option. Otherwise, the new scheme is going to come out very soon. The details are yet to be come.
Thank you. Thank you. So we will tell everyone to be patient on that bit. And if I may say the last question for today's webinar, what is the impact of the union budget on the German companies who plan to expand their operations in India?
I take it. Anand goes for it. Anand, you go for it. Yes.
I'll make two statements.
Perhaps both. Yes.
I mean, see, this is we can see a clear trend of new companies coming into India, of course, and then we see that specifically a lot of companies which entered India under the agency model or the distribution model are now slowly going into the manufacturing model, because it makes more sense to produce in India, because you get the cost arbitrage, you get the raw material, and you have a big local demand, right? So for people who are expanding in India, you can have a lot of things to look forward to. Of course, on the manufacturing side itself, lower costs, better pricing, of course, a challenging market. I'm not questioning that. But, from India also to cater to ASEAN region or to the African region, I see when I discuss with a lot of managing directors, I see they talking about, trying to export from India because you can produce at a lower pricing here. At the central level, of course, you have the central government policies, but you also have state government policies. So if you're looking at expansion, for example, you can also go for state subsidies. Every state is competing to get the investments into the specific state. And they give really good subsidies if you try to really, establish your manufacturing in their specific states. So many things to look forward to. fiscally as well and from a market point of view as well. Prasenjit.
Yeah, no, I think you've covered it well, Anand. Just to reiterate the, the regulatory certainty, the deal-making certainty, the investment climate certainty. I think that is often, the most critical factor to encourage investors to look in India and remove any kind of dilemmas or skepticism. So I think that would be the biggest, I would say, takeaway, which one, if reads into this budget 2026, not explicitly spelled out necessarily, but if you read between the lines in the budget, that's the confidence boosting sentiment which I will take away as the foreign investor.
Thank you very much, gentlemen. And this is also supported not only on paper, but when you have politicians and the key vital policy makers. The last one that we saw was Mr. Piyush Goyal, who came to Germany just a few months ago. So this is also supported that it's not only on paper, but they are also taking the effort to crossing seas and coming to Europe and especially Germany to prove their point here. So before we end, we have two important announcements to make. The Embassy of India has their date for the annual event, the Make in India Mittelstand Exchange Program. It's going to be on 19th March 2026 in Berlin. So please save the date. More details on this will follow. Sweet. And another announcement, another opportunity, since we've spoken so much about India, the Baden-Württemberg International is organizing an exclusive delegation trip to Bengaluru, Chennai, and Coimbatore, 16th March to 20th March 2026. Details are there on your screen, ladies and gentlemen. Save the dates, the contact details. This is a wonderful opportunity to explore what the three cities have to offer. Definitely a must. And with that, a big thank you to our dear speakers here today for joining us for this webinar, and attendees for your patience listening, and our brilliant backend support team of Jessica and for the continuous support. So once again, thank you very much, and looking forward to your continued partnership and participation in large numbers for the coming year. So thank you once again, everyone. It was wonderful.
Thank you very much. Thank you.
Thanks a lot.
Thank you.